Understand there's a 100% correlation with what happens to a company's earnings over several years and what happens to the stock. If the company, McDonald's, has done very well as a company,
right,
the stock has done very well. People worry about too much money supply, what's happened to the price of oil, whether, who's the president, who's being nominated for the Supreme Court,
it's all
the
earnings.
ozone layer. It has nothing to do. McDonald's earnings go up the next 10 years, the stock will go up.
Yeah, but what they will say to you, Peter, is that, as you know, and why am I telling you this, but anyway, it's fun to tell you this, they're telling you that these other things influence the amount of earnings of a particular company.
Yep.
If we're in a recession, people are not going to spend
That's
as much money on going to the movies
Absolutely.
or whatever they do.
Right.
And therefore, you got to pay attention to these other things because they impact on earnings.
They are very important, but you have no idea of knowing what they're going to do. Alan Greenspan's the head of the Federal Reserve.
Right.
He cannot predict interest rates.
Yes.
He'd be the first to tell
He can
you.
influence them, but he can't predict them.
He cannot predict what long-term interest rates are going to be 1 year from now, 2 years from now, 3 years. He's even surprised how low they are now. So how am I supposed to predict interest rates? How am I supposed to predict the economy? You certainly remember the recession of '82.
Yes.
In 1982, we had a 20% prime rate, 14% unemployment, 12% inflation. I don't remember anybody telling me in 1980 or 81 that was going to happen. All of a sudden, we had the worst recession since the Depression. I didn't read about it in the paper. So it's crazy to think about these things. Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated. People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict interest rates. If anybody could predict interest rates right 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet, there can't be that many people who can predict interest rates because there'd be lots of billionaires. And no one can predict the economy. I had a lot of people in this room were around in 1981 and 82 when we had a 20% prime rate with double-digit inflation, double-digit unemployment. I don't remember anybody telling me in 1981 about it. I didn't read, I studied all this stuff. I don't remember anybody telling me we're going to have the worst recession since the Depression. But I'm trying to tell you it'd be very useful to know what the stock market's going to do. It'd be terrific to know that the Dow Jones average a year from now would be X, that we're going to have a full-scale recession, or interest rate's going to be 12%. That's useful stuff. You never know it, though. You just don't get to learn it. So I've always said, if you spend 14 minutes a year on economics, you've wasted 12 minutes. And I
a huge run. I mean, the market was 4,000 just 2.5 years ago.
Yeah.
And it ran up to 8,300 in August. And like any big rally, sometimes it backs off. I mean, it's healthy. In fact, I'd rather have gone down 1,000 points than gone to 12,000. If you look at Japan, Japan went from 5,000 to 15,000 on their Dow, and it was fairly priced at 15,000 on earnings and everything else. Then it went to 40,000, and that caused 7 years of inflated real estate, people overspending, and basically they've been in a recession for 5 or 6 years because the market went up too high. If the market goes too high, you're discounting earnings 7, 8, 10.
Right 6 times out of 10. But if I'm right, I make a double or triple occasionally. It offsets the times you lose 30 or 40%. In fact, you could be right a third of the time as long as you have a lot of good results. So when you're short, you can only make 90%. When you're long, you can make 10-fold or 5-fold. So I think long is the way to be. Corporate profits have grown about 7 or 8% a year. That means they double, including dividends, about every 10 years, quadruple every 20, go up 8-fold every 40. That's the kind of numbers you're interested in. Then a 10-year bond today is a little over 2%. So I think the stock market's the best place to be for the next 10, 20, 30 years. The next 2 years, no idea. I've never known what the next 2 years are going to bring.
Take a coin out and flip it. I have no idea what the next 1,000 points is going to do. The next 6,000 points is going to be up. The next 14,000 points is going to be up. The next 20,000 points is going to be up.
But you don't know what the next 1,000 is going to be. It
Nobody
could be down,
does.
could be up.
Nobody does. And it's futile to try and guess it. Corporate profits will be a lot higher 10 years from now. They'll be a lot higher 20 years from now. That's what you could rely on. Microsoft didn't exist 20 years ago. Staples didn't exist 20 years ago. Federal Express didn't exist 20 years ago. New companies will come along. That's what makes
Cisco
stocks
didn't
go up.
exist 20 years ago.
That's what makes Amgen has 2 $1 billion drugs. They didn't exist 20 years ago. New companies have come along. That's what makes this country work. You say to yourself, I think this company's going to earn something in the future. If it's already discounting that, if it's selling at a huge multiple, you say it has to work, and then it's only going to stay even. So you have to say to yourself, if I'm right, how much am I going to make? If I'm wrong, how much am I going to lose? That's the risk-reward ratio. In Stock Shop, we talk about, if I'm right, I hope I'm going to double, triple my money. If I'm wrong, maybe I'll lose 30, 40%. That's a favorable ratio. You say, if I'm right, the stock's not going to go up. It's already discounting terrific things. If discounting terrific things are already in the stock, I don't know. All these public companies out there. Here's a company I really like. The fundamentals are terrific. Their earnings are doing well. Their competitors are doing poorly. I think this company's doing terrific. And all of a sudden, the stock might have gone from 40 to 30 because of this decline. That would say, wow, here's a chance to buy it. So you're trying to say some companies might have been overpriced at 60, and all they did was go to 50 and say, big deal. So you're trying to find companies you liked anyway. Right now you liked them. And now they've had a haircut. That's what you would do. Not a stock that went from overpriced to fairly priced. Something that was fairly priced at the start of this exercise.